right, so I'm Austin Billiou,
I'm Aaron Buteri.
and we are pitching Global Water Resources, Inc. So what is GWR, Global Water Resources? So they're a fully integrated water utility, something they call total water management. So they do the water services, the wastewater services, and the recycled water services. They provide all three of those. We'll get into more detail of those. They serve more than 55,000 people and about 21,000 homes with 352 square miles of service area. The way they describe their business model is our basic premise is that the world's water supply is limited and yet can be stretched significantly through effective planning, use of recycled water, and by providing individuals and communities resources that promote wise wastewater usage practices. So why GWRS? So that's a graph of their stock performance compared to the XLU. We're recommending a buy. And so our three big points are their growth. They are mainly operating around Phoenix, Arizona, and that surrounding area. Also, the state of Arizona has a highly fragmented water utility market, which we'll get into in detail later. They have a fairly high dividend in comparison to other companies within this sector. And they have that fully integrated service, which allows for more efficiency in their operations. So to get our target price, we used free cash flow to equity because they do have some debt on their balance sheet. We used price to sales because they've only been a company for 3 years. That first year was negative earnings. The next 2 years were positive earnings, but it seemed to get us a little bit more accurate read there. And then the dividend discount model because they give a dividend. So revenue segments. So the water services, that one's pretty straightforward. That's the water that they're selling to residents. That is the amount of water, so it's volumetric. There are some standard fees that come with that. The connection fees with setting up that setting a connection to an existing water meter connection. And then you have the meter installation fees, which are when the meters are initially put in, when you get a new home. Wastewater and recycled water services, so that's billed at a fixed monthly amount per connection, and recycled water services are billed monthly based on volumetric fees. So they take the water, and then any wastewater, any gray water that goes down their drain, that comes back to their facilities, they clean it, they purify it. It can then be used for drinking water, depending on how they process it, or just irrigation, crops or fields, soccer fields, things like that. And then we have unregulated revenues. It's a very small percentage of their revenues. We'll get into that as well. Oops, I guess I have my notes. My notes are not.
So GWRS is kind of odd in that we are looking for growth in the utility stock. Generally, utilities aren't known for growth. However, GWRS has been making some very aggressive acquisitions in Arizona and the Phoenix area. It's worked pretty well for them, and it looks like it's going to continue, so we think the stock's going to grow. In 2018, they purchased Red Rock Utilities, as well as Turner Ranch's Water and Sanitation. In 2016, they acquired a different company, which got them. They acquired quite a lot of debt with it as well, but that's just all part of growing bigger. There is also, due to utility companies being regulated by the ACC, I believe that's the Arizona Corporation Commission. They're the ones who set the rates, basically what you can charge people for their water, because utility companies are pretty heavily regulated, so because they're monopolies and they don't want to gouge people for their necessities. But those rates are being increased as of 2015, and they get phased in until 2021. So each year they can collect just a little bit more from the people in the area and charge them just a little bit more for their utilities. So from 2015 to 2021, they can collect an extra $3.6 million in revenue.
Real quickly to go back to, you got cut off there, but they're called ICFAs, Infrastructure Coordination and Financing Fees. It's essentially when a developer and home builders, when they're going to build a new home, oftentimes we will kind of front that cost of coordinating, putting down that infrastructure to actually get water to these places that would otherwise have to be incurred by the subcontractor or the developer. So this is more about that market fragmentation, and I know that map's kind of hard to see, but it's the only one that they had. Essentially all these little places like this, those are all different water companies that are small, that are privately owned. There's over 400 of them owned by, or operated by over 350 companies. About 21 of those are wastewater, 20 of those are combination water and wastewater providers. And so they are currently, like we said, growing through these acquisitions. And right now, they're in that Phoenix area, which, that's Pinal County, Phoenix is somewhere right in there. So they have essentially, from this point, they can start expanding outwards. And what they're buying, essentially, connection places where Phoenix is going to expand outwards into. So there's already a couple water utilities that provide the main water service to Phoenix, it's feeder Phoenix Water Company. But it's just like barely outlying towns like Eagle Rock, I think is one of the names of one of them, where it's just barely outside of there where we have the connection. So when it expands, we're going to get to fill up those new connections. So more on that population growth. So the Phoenix metro statistical area is the 14th largest in the U.S. According to the 2010 census, there was about 4.2 million people. It was expected to grow by 4.9 in 2020 and 6.5 to 2040. During the 12 months ending June 30th, the employment rate improved by 2.8%, top third, and on June 30th as well, the active connections increased 8.9%, which is what this graph is showing right here. So this is our total active versus total connections. So you can have a connection, but nobody might be living there, so it's not active. And as you can see, that gap has gone up and it is closing.
All right, so the dividends. Something we thought at least interesting about this company is that their dividend payout ratio is pretty high compared to their competitors. All the other stocks we've got there are the comparable companies we chose. They're ones that have similar market caps. They're kind of, they have a similar integrated structures where they do all three parts of the water cycle. However, ours, the dividend payout ratio is just huge. So that is kind of interesting because it may be unsustainable in the long run. You know, you can't keep paying out 184%. But this year, it's projected to continue to be above 100%, and maybe the year after that too. So that's a good sign, but it's also something to keep our eyes on.
Kind of financing that through their acquisitions when they purchase a new company is how they're keeping that rolling. So if they continue to make these acquisitions, they should theoretically be able to do that. And this is just a comparison of them versus other companies.
All right. So for operating performance, something to look at when we were looking at our line for return on assets, the percent. 2016 is kind of an outlier in this, and we'd be doing a lot better if you take in the past 2 years of growth, because you've got 2017, it was doing quite well, 2018, and then the trailing 12 months is projected to be above 2018. So taking out 2016, our return on assets, which is quite low compared to the average of the other competitors, would be doing a lot better, but mostly that's just because we have a lot more assets. We've been making a ton more acquisitions, and the revenue just hasn't caught up to all these new assets that we picked up. Operating margin has been consistent. It's only gone up, and it still remains to see if it will continue to improve in this quarter, but it is not doing poorly. And revenue is doing well as well. It's only gone up since 2016.
Right, 2016 was their first year that they did their initial public offering, so they've only been a company for 3 years now. That first year, they also did another public offering in 2018 where they made $15 million, I believe was what it was, off the revenues from that. So they have been putting out more stocks, which comes with its own risk there. I mean, a lot of stocks get put out into the market, could lower the stock price, kind of dilute that, also lower earnings per share. So one of the big kind of, not problem that they have, but they have a lot of long-term debt. So during that 2016 time, when their initial public offering, they had the option to refinance their debt essentially and get a lower interest rate. So that's what they did. On June 24th, they issued 2 series of senior secured notes with a total principal of $115 million, a blended interest of 4.55%. Neither one of those are due for quite some time, 12 years and a 20-year term on the larger. And interesting interest for the first 5 years on that one, and then an annual or semi-annual 1.9 million principal payment after that. And that was to refinance those long-term tax exempt bonds that they had, which were set to mature at 103% plus accrued interest. When they did that public offering, they could have, bondholders could have called that on and say, hey, we want our money for this now. So to have that loan though, they have to have a debt service coverage ratio of consolidated EBITDA to consolidated debt service ratio of 1.1 to 1. I have exactly what that means, but it's just essentially the way for the whoever gave the loan to say, hey, this is exactly how much assets you need to have to your
So are you currently meeting or exceeding
They
that
are
coverage
currently meeting
ratio?
that, yep,
By
yep.
how
They-
much?
I didn't look up exactly how much, but they said they were meeting it. I can look that up for the future though.
Alright, so risks. So utility companies face a lot of common risks. One of them again is regulation by the ACC, based in Arizona. So this is quite good because Arizona is a state that has the government isn't very strong there, and corporations do have a lot of freedom in the rates that they can charge. Like right now, we don't have to worry about another rate change until 2021. It's currently still going up. So they can continue to charge more for their utilities. So we don't really have to worry about that particular risk, but it is always something to keep in mind, is that just depending on the political atmosphere, they can lower those rates down.
Right, they said they apply for a rate change. It usually takes, so you apply for it in 1 year, it takes 1 year to get processed, and you can see it start to get put into effect in the third year. So really every 3 years, you'll kind of see either a stagnation in the rate or decreasing.
Right. And if standards change for health regulations or environmental standards, as far as, I mean, if you're operating a utility company, you are delivering a lot of water to a lot of people and they're drinking it, and if suddenly something changes and you have to add in a new filtration system to every single one of your active connections, then that can incur heavy costs. And they haven't, I mean, that doesn't happen very often, but it is something to keep in mind, especially depending on the, I guess, the political atmosphere, who's in the government. That can happen, and you have no choice but to incur those costs and fix that, or you're kind of out of business. Also, it's Arizona, very arid region, very dry. Droughts can just affect you severely because, I mean, a lot of this water is coming out of the local water table and getting reused, and yeah, it's not good if you're running water in the state because you have less supply.
So do they have any drought management provisions in place?
That's what that integrated water service is supposed to essentially manage by controlling essentially where all of the water goes. You can repurify it, reuse it, instead of having to constantly pull from the water table. A lot of companies in Arizona, specifically Phoenix, they all have to sort of work with that because it is a desert, it is facing.
So they use recycled water for things like watering golf courses, et cetera. Is that essentially what you're saying?
Yeah, a lot of that, I believe, you can also drink it as well, although that's not as common, because nobody likes the feel of that. But yeah, mainly you can use for irrigation.
Are there any sort of rate differentials for using recycled water versus?
They didn't, I didn't consider that. It didn't mention anything about that though, but I'll double check on it.
Like my water can be cheaper if I buy recycled, or
Right, maybe.
So
Why don't you need
a
more?
lot of water utilities have like differential tariffs depending on the type of customer. So like if you're a commercial user or an agricultural user, you're charged a different rate than like a residential user. And so residential users will usually get the fresh water, whereas if you're a commercial user that is using water to do things like water, golf course, or cotton plants or something, then you don't necessarily, like you can use the recycled water and are charged a different tariff because of that.
On the point of that, they are mainly residential. That's where they get the majority of their income. Joel, you had a question too?
That was my question.
Okay.
How old is their infrastructure?
2004 is when they were originally coming up.
So, and how is their CapEx relative to kind of replacement rate, like depreciation of their assets?
CapEx capex relative to depreciation rate. So they use straight line depreciation, are the valuation template that we used, put it at like 64.7%. I guess, explain that a little bit more, I'm a little confused.
So, so depreciation is always not, is not always the best actual assumption for how quickly like infrastructure needs to be replaced, but if you kind of think of it as a rough guide, like you're depreciating it over the useful life of that infrastructure, so you should be investing in new infrastructure at least a replacement rate. So
Okay.
then if CapEx is directly equal to depreciation, then you are replacing infrastructure at the same rate that it's being depreciated or depleted.
Okay, they do have a chart in here that describes the useful life of some of those assets, so I would take that and.
I would think about that and also just read through their management discussion and analysis about like their reinvestment in infrastructure.
Okay.
The idea here is, you're probably familiar with Flint, Michigan, and some other cities that have some issues with their water infrastructure.
I briefly read something about that. It was there was the brand of pipe that Michigan used. We don't use that. That essentially series of pipes I think is phased out. Everything in Phoenix is new, so those pipes aren't being used. So we shouldn't have a Michigan water problem, but maintenance.
Are you at all concerned with the geographic concentration of this company? Like, Phoenix is predicted to grow, but what if there's an economic downturn? Like, with the last housing crunch, the Sun Belt was hit extremely hard.
Right. That is a risk, but it's hard to know that. So far, the only things that I've seen is projections for growth, unless it's a whole United States recession. Yeah, that's a risk. I'm not sure how we would mitigate that though.
A company that's more diversified geographically.
I guess yeah, it's still one that's what it is. Yeah.
Why did they have negative earnings per share in 2016? What happened in 2016?
In 2016, it was
They did acquire another company in 2016. I don't know if that's related.
Sorry, hold on. Well, here, I can just do that. 2016.
What happened in 2016? Do you have a stock price chart? Because the one on the handout is hard for me to see.
Yes.
So is it the red line or the blue line?
So yeah,
What
blue line is GWRS, red line is XLU.
is what it?
The XLU,
Okay. Utilities.
yeah.
And the starting point there, is this a 5-year?
It's a 3-year because they don't have 5-year data, the
Oh, yeah.
2016.
So, yeah.
The 16.
Do they have any sort of schemes in place, like rebates for limited water use, et cetera,
They
for
do,
customers?
yeah, if you use, they didn't talk a lot about that in their 10K, they did mention it on their website though, because they're pushing for that water conservation, if you use less than some amount, essentially you kind of get like a little bit of a discount.
I would say, you might have a different political climate in Arizona, but I would look at some of the measures that some of the like water utilities in California have implemented, like they have, like fees on top, like basically drought fees, so when like a water emergency is declared, they can charge customers more, a bunch of things
Okay.
like that. And see if you think that's kind of the future of water and water in a region like this where water is probably a scarce commodity.
From what I read from Phoenix Water Commission. They had like a frequently asked page, and one of those questions was, should we worry about water supply here in Phoenix? And the way they described it is that no, we've had over 100 years of good planning to make sure that we aren't as affected by that. So they kind of talked about that, but I can pull up a lot more detail.
Yeah, I would do a little digging.
Okay.
Questions from the class?
Yeah.
Their PE is at 124,
Mm-hmm.
and all of their competitors are around 30.
Right, because their earnings aren't that impressive, because they're essentially using a lot of that cash to fund growth. So we're willing to pay a lot for that meager amount of earnings.
Right, for the dividends.
And most,
And
That why you chose a price to sales ratio for
Yeah,
your
yeah.
evaluation?
Yeah.
oh, and then their long-term debt, is it just a typo, or did they get 100 more of long-term debt from 16 to 17?
it should be 115 through the entirety, 2016 to 2018. Yeah, sorry.
That's fine, I wasn't sure.
Yeah,
Because
so it's
got
18,
a lot of
15
debt.
around there.
Yeah.
Yeah.
They went from 14 to 114, so I was
Oh,
like,
yeah, should be 114. Joel.
You're talking about they're purchasing as many companies as they can around the Phoenix area.
Mhm.
Is there any other like elements to their strategy about the types of companies they're purchasing, or are they just trying to purchase all of them and have a monopoly of the area?
I think they're just trying to follow their integration strategy, which is just the distribution of the water, the collection of like sewage waste, and then the repurification of that. So I believe, at least from their acquisitions in 2018, they were all companies that fit within those, just kind of those confines so that they can manage a different part of the water cycle in each of those areas.
Yeah, so because they're purchasing all the different companies and they offer different water services, is it more efficient for them to do that? Or do each one of these companies, after they acquire them, will they operate separately from the other companies, or will they be interconnected?
I think they operate separately. When you look on their website, it seems like they have different like rates for. So they have the Palo Verde and one other section. It essentially accounts for 92% of the revenue. Those are the largest
So
pieces.
it's not like a huge cost-saving benefit to acquire all of them,
I
but
think
there
it's
is
kind of
some.
Right. It's mainly just.
An administrative benefit, if anything, in that if you have accountability over basically everything. If someone's doing something that doesn't work for the next part of the supply chain, if their sewage they're not transporting it in the correct way, and you have to spend a lot of extra money to purify it or something, you can, kind of work with the other companies that are in that chain, be like, okay, you guys gotta do this with the sewage, you gotta transport it to us this way, and then we can save a whole lot of money on both ends, rather than having completely separate entities that might not have the same goals in mind.
And then last question, does all of the water, is it all groundwater, or does some of it come from like the Colorado River or other rivers?
It's called the biggest provider of water in the Phoenix area is Salt. I can't remember the name of it now, but it's essentially they'll bring in water. That's mainly who provides water to Phoenix, but they do take some from groundwater as well. It's kind of a mix of both. They've talked about that. A lot of it is provided through this. Gosh, I can't remember. It's Salt is what the name of it is, but
Salt is the name of the company?
yeah, it's either that or the project. I can't remember.
So like a third of the water for Arizona itself comes from the Colorado River, a third comes from groundwater, and then a third comes from other rivers besides the Colorado River.
Right.
And I just happened like 2 days ago to do a bunch of research on like what's happening with the Colorado River, and it's basically like getting drained the farther south you go. So I was just wondering if that's where the water is coming from.
Okay.
Is it the Salt River? Because there is a river called the Salt
Is
River.
it the
that
Salt
flows
River? Yeah, I was
through
like, I
Arizona.
remember reading that, but I couldn't remember. That's
Right by Phoenix.
Yeah, that's where all that water comes from.
Okay,
Yeah.
so most of their water is coming from rivers then.
Right. Yeah, and they
Okay.
said if there's if the Salt River kind of dries up, they said they can start taking from the groundwater to help mitigate that, but that.
Mhm. Okay, because there is a big political movement about like water uses, especially in areas like that,
Right. Right.
about draining rivers and things like that.
Mhm. Yeah, water conservation is huge there.
Yeah.
Yep.
So
So, GWRS is a private company that gives water to people in Arizona. Now, do people get the choice of going with GWRS? Because like if you live in the city of Wasilla, you get city water and there's no negotiating, like
Yeah, it's
everything
whoever
is-
has a connection, so,
Okay.
yeah, it's, a lot of them might be the Phoenix Water, company, there was one more in town, but essentially, if you already have a connection to this place, you're not gonna tear it up and give it to somebody else. You're gonna have to buy that company, or through some negotiations, create some new infrastructure for your facilities to reach there. So essentially, they, have set up facilities that can provide water to an area that doesn't currently have any infrastructure.
Okay, so their option. Does Arizona like that? Because there's
Yeah.
still, because like,
Arizona, yeah,
for
so.
example, Wasilla doesn't, there's certain parts of outside of city limits that don't wanna be connected, because then they'd start having to pay for water instead of doing their own thing. So does Arizona want to be incorporated in larger water plans?
So the ACC, they were talking about that market segmentation. It's more efficient if, like all the administrative fees and fees like that, can be more widely distributed if you are a larger company. It can be distributed over your larger customer base. So if you have a small water company, they're gonna end up paying more because they have to incur all of the costs of the people that work there. So they would like to see consolidation in the markets.
So I think I think I like your line of questioning. In Arizona, I don't think you can go and drill a well in your backyard and hit the water table. My assumption, given what I know about the area, is that it would probably not be economically viable.
I think there's systems
so
like
the-
this.
Alternative to being on city water would be very limited unless they also have water hauling services, which personal experience down in lower 48, I have not seen a market that is served the way Fairbanks is with water trucks. I think it's a fairly rare kind of setup up here. So I would say most customers probably have like one choice, and it's a regulated monopoly, which isn't uncommon with utilities.
More questions?